There's a factory at the edge of town that never makes the morning paper. Its smokestack is short, its signage is dull, and no influencer has ever filmed a glossy tour of its production line. Yet for 50 years, that exact factory has turned out the same steady product, paid modest dividends, and quietly expanded its footprint month after month. People walk past it without a second glance. That invisibility, its ordinariness, is precisely why it deserves your attention. Here's the simple thesis. The most reliable path to long-term capital growth is not the flashy headline. It's the patient, disciplined ownership of quiet businesses and disciplines that compound. Most investors don't fail because they lack data. They fail because they rush, they overreact, and they underestimate the power of small, repeated mistakes. If you learn to see the forgotten factories, the steady, dull assets overlooked by others, and to hold them with discipline, you will turn modest beginnings into meaningful wealth. That's the sort of thing Charlie Munger trained his mind to notice, and the 5 rules distilled from his thinking are our roadmap. Before we walk the path, let's dismantle 3 excuses that stop otherwise sensible people from starting. First, I don't have enough capital. Imagine you are standing before a field and saying you can't farm because you don't own a tractor. Start with a spade. Compounding doesn't demand a fortune to begin. It demands time, consistency, and avoidance of leaks. Small, regular contributions grow in ways most people underestimate. Second, the market is different now. Headlines change, human tendencies do not. Greed, fear, and short attention spans repeat themselves. The instruments may mutate, but the basic math of investments, buying income and owning productive assets, stays the same. Third, it's too late for me. The cost of delay is real, but it's rarely decisive. Starting 5 years later hurts, yes, but starting is still better than standing still. Time is a multiplier. Active patience begun now beats paralysis. If any of those thoughts landed inside you, hold them gently but firmly as we go through this. There is a practical roadmap ahead. And if you want the full 5-rule breakdown to return to later, subscribe or save this video now so you can come back and work through each rule at your own pace. Now, a crucial organizing idea. Think of success as a house built from 2 types of bricks. 60% of your results come from avoiding hidden leaks, small errors that compound into big damage. 40% comes from the positive actions you take, the investments you choose, the businesses you hold. That 60-40 split is not a model for portfolio construction. It's a mindset. Too many investors chase the 40%, the shiny strategies, while ignoring the slow bleed of fees, taxes, overtrading, lifestyle inflation, and careless capital allocation. The forgotten factory teaches us a different discipline. Secure what you have first, then allow compounding to do its work. What do these leaks look like in practice? Picture a bucket with a slow leak. Each drip is trivial on its own. One unnecessary trade here, a high-cost financial product there, a tax inefficiency, a habit of inflating personal spending as your balance rises. Over decades, those drips eat a hole in your future. One obvious form of leakage is turnover, the habit of buying and selling too often. Another is narrative dependence, buying an investment only because the story sounds good on social media, not because the underlying business produces durable cash. Then there's selective caution, being hyper-conservative about small, safe opportunities while recklessly speculating on fads. Add in lifestyle creep, raising your standard of living in lockstep with every small gain, and suddenly the compounding math turns against you. To bring the math into focus, consider two hypothetical savers and clearly state the assumptions. These are illustrations, not promises. Assumptions. Contributions are monthly. Returns are hypothetical and constant for simplicity, and all figures are in USD for clarity. Assume a 7% annual return compounded monthly, representative of a long-term real return target after inflation in many conservative illustrative models. Investor A starts saving $300 a month at age 30 and continues until age 65. Under our assumptions, by age 65, this investor accumulates roughly $750,000. Investor B waits until age 35 and then saves $300 a month until age 65. With the same return assumptions, Investor B finishes with roughly $510,000. 5 years of delay cost Investor B about $240,000, not because they saved less per month, but because they lost 5 extra years of compounding on the principal. This is a stylized example, but it reveals the invisible force of time. The difference is not a secret, it's arithmetic. The point is simple. Begin with what you have. To carry the metaphor deeper, imagine two farmers planting orchards. Farmer 1 plants a small number of trees and tends them carefully, protecting young shoots, pruning at the right times, reinvesting a portion of the fruit into new saplings. Farmer 2 plants fast, moves on to the next field as soon as the first promise shows, borrows to buy a bigger tractor, and spends the fruit on early comforts. 10 years out, Farmer 1's orchard is a steady income machine, producing reliably and appreciating in value. Farmer 2 owns more equipment, but his harvests are inconsistent and his debts higher. Which farmer would you trust to quietly grow capital over decades? The answer is obvious to someone who understands compounding and capital preservation. With that mindset in place, we move to the rules. 5 practical interlocking principles taken from Charlie Munger's philosophy. Each rule acts like a safeguard for the forgotten factory. They help you identify, buy, protect, and patiently steward durable sources of wealth. Rule 1. Circle of competence. Define it simply. Know what you understand and, importantly, what you do not. Your circle is not a badge of limitation. It's a framework for focus. Most people think competence is about appearing broad, reading everything, dabbling in every fad. The behavioral error it counters is overreach, the conviction that because you can follow a story, you can value it correctly. Picture the forgotten factory again. A business with straightforward operations, clear cash flows, and understandable risks sits on a small street. You, as an investor, can either study its accounts, talk to a former employee, and understand how it makes money, or you can buy into a complicated derivative because its ticker climbed 300% last year. A smaller, honest circle of competence outperforms a broad, shallow confidence because it reduces the chance of misunderstanding critical business mechanics. Narrative vignette. A mid-sized family-owned textile plant sells its cloth to local hospitals. Its margins are modest, its customers predictable, and its management has a conservative approach to debt. An investor who truly understands supply cycles and contract structures can assess the plant's durability. Another investor, dazzled by a trendy tech narrative, misreads revenue spikes in a different sector and loses capital when novelty fades. The former sees value the market ignores. The latter chases noise. Numeric illustration, hypothetical assumptions explicit. Suppose you identify a small manufacturing business that, under conservative estimates, can deliver a 6% annual cash return on invested capital over time. You are confident in this because you understand the raw material costs, the contract terms, and the local competitive landscape. If you invest $100,000 at a price that reflects that reality, and you hold for 20 years without unnecessary trading, at 6% annual compounding, your investment grows to about $320,000. The point is not the exact number. The point is that understanding leads to conviction, and conviction allows calm, patient holding. Practical habits to adopt for your circle of competence. Write it down. Define industries and business models you actually understand and why. Be explicit about what you exclude. Use a teach test. If you can explain how the business makes money to a smart friend in simple terms, you probably understand it. Limit exposure to areas you only follow and increase allocation to areas you can model confidently. The circle of competence reduces costly mistakes by narrowing your universe to businesses you can value with reasonable confidence. It does not mean you never learn new sectors. It means you train before you trade. Rule 2. Margin of safety. Define it simply. Buy assets at a price meaningfully below your conservative estimate of intrinsic value. The behavioral error it counters is optimistic pricing, the tendency to overpay for good stories. Why does the margin matter? Because the price you pay determines your future returns and gives you a buffer against uncertainty, missed forecasts, business hiccups, management errors, or plain bad luck. Consider the forgotten factory again. 2 buyers bid for the same plant. One offers to pay the full, cheerful number, matching the seller's dreams. The other offers a price that recognizes hidden risks, equipment replacement costs, potential customer losses, or a small regulatory change. The latter buyer is protected. If turnover occurs, if a competitor appears, or if profits falter, the buyer who paid less does not need miracles to make a satisfactory long-term return. Numeric illustration with assumptions labeled, suppose you estimate a business's intrinsic value today is $100 per share based on conservative cash flow forecasts. If you pay $100, your margin for error is 0. If your forecasts are off by 15%, a small error, you may find that the investment underperforms substantially. If instead you buy at $70, a 30% discount, your downside is cushioned. Even if the business underperforms your conservative model by 15% over the next decade, the lower purchase price allows a reasonable chance of still earning an acceptable return. For example, if the business's true long-term fair value grows at 4% annually, a $70 purchase today will outperform a $100 purchase over time because the starting point is lower. Actionable checks for margin of safety. Build 2 valuations, a conservative case and an aggressive case. Treat the conservative one as your decision anchor. Require a minimum discount threshold before buying. This could be 20-30% of your conservative intrinsic estimate, depending on the uncertainty. Ask, what would make me regret buying this? If the regret hinges on factors you cannot assess, increase the required margin. One of the simplest truths of long-term capital stewardship is this. You cannot predict the future perfectly, but you can buy with a buffer. Rule 3. Invert the problem. This rule smells like a thought experiment, and that's deliberate. To invert is to ask the reverse question. Instead of, how can I make money? Ask, how might I lose money? The behavioral error it counters is goal-only thinking, which blinds you to failure modes. Inversion forces a checklist of things that will ruin returns. Start by listing failure modes for the forgotten factory. A key customer cancels. Suppliers raise prices. Management takes on unsustainable debt. Regulatory changes reduce demand. Or a new technology makes the product obsolete. Once those possibilities are visible, you can design protections. Diversify customers, require covenant health in purchase agreements, demand conservative balance sheets, and so on. Narrative vignette to show inversion's power. Imagine an investor considering two factories. Factory A has a single major contract that accounts for 60% of revenue. Factory B serves many small accounts. A straightforward make-money analysis might be dazzled by Factory A's short-term margins. Inversion highlights a hidden dependency. The loss of that single contract could be catastrophic. Inspection reveals that Factory A's margins rely on favorable raw material prices that could change with a single supplier's action. The investor who inverts will either demand a lower price or walk away. Numeric example to illustrate the asymmetric cost of loss. Explicit assumptions. Suppose a portfolio loses 40% in some scenario. To recover to the prior level, you need about a 66% gain because the base is smaller after the loss. This is not advice, just math. That asymmetry explains why large drawdowns are so costly. The deeper the fall, the more painful and unlikely the recovery becomes. Make this hypothetical. Assume a portfolio valued at $100,000 declines to $60,000, a 40% loss. To return to $100,000, the ruined asset needs a gain of $40,000, which is 66.7% of $60,000. This is the arithmetic of inversion. Identify what leads to those huge declines and guard against them. Practical inversion habits. Before any investment, run a how do I lose 50% thought experiment. If you can't identify plausible mitigation, reduce the position size. Force yourself to name 3 independent ways the thesis could fail. Use stop and review rules that are about diagnosis, not reflexive selling and panic. At this point, we have opened the first 3 of the 5 rules. Each one ties directly to the forgotten factory metaphor. Know what you understand, buy with buffers, and habitually ask how things break. The first 2 rules build conviction and protection. The third turns your attention to failure modes you might otherwise miss. Before we go further, though, pause and consider why these mental tools are more powerful than 100 timely tips. Information is abundant. What's scarce is disciplined thinking about what not to do. The 60-40 framework returns here. Most of the damage that kills long-term capital is invisible and incremental. In my experience as a careful observer of investors, the most successful ones are not those who obsessively chase new ideas. They are the ones who spend more time preventing small mistakes. To bring the point home, a second farmer example helps. This one follows the psychology of taste versus steak. Farmer 1 follows the rulebook. Every harvest, she sets aside 40% of the crop to plant more trees and to cover repairs. She keeps a careful ledger, avoids flashy equipment leases, and lives modestly. Farmer 2 celebrates early success with larger meals and a new barn paid for with a loan. Then a few poor harvests hit. Farmer 2's loan covenants force hurried sales. The farm's value collapses under stress. Farmer One endures because she anticipated risk and preserved capital even in abundance. We could stop here and say the moral is obvious. Preservation and prudence win. But simple does not mean easy. Human behavior is messy. That's where the fourth and fifth rules enter. Protecting capital before seeking growth and treating patience as an active, disciplined strategy. Those are not theoretical add-ons. They are operational demands. They require rules that stick even when markets get noisy and when early success tempts arrogance. Consider a cautionary arithmetic point about losses and recovery that will shape Rule 4. It is not hypothetical to say that large drawdowns impose a multiplication problem on the rest of your capital. A 50% loss requires a 100% gain to recover. A 30% loss requires about a 43% gain. Those percentages are not motivational platitudes. They are bite-sized math that should make you hesitate before taking reckless risks. In practice, an investor who avoids a single large loss will likely outperform another who chases higher returns but suffers occasional catastrophic setbacks. We are about to move from diagnosis into those later rules, where protection and patience are described not as passive virtues, but as active investment practices. But before that, one more small pause for the practical. If you've been nodding along, it's worth creating a simple habit right now. Write down one thing you can stop doing this week that drains capital. It might be cutting transaction frequency in half, canceling a recurring subscription tied to financial noise, or drafting a rule that any investment above a threshold must pass 3 written tests: circle of competence, margin of safety, inversion analysis. These are modest acts, but they plug the drips we talked about. Now, as we begin the fourth rule, think about the forgotten factory's balance sheet. Low leverage, steady customers, and slow but reliable reinvestment. Protecting capital is not about fear. It's about preserving the fuel that allows compounding to operate. The moment when capital is most vulnerable is often after some success, when confidence outpaces competence. The temptation then is to scale positions, add leverage, or outsource oversight to a shiny product promising higher returns. That is where systematic checks are critical. Imagine 2 investors after a series of winning years. Investor 1 sets strict allocation limits, writes an annual review, and keeps decision-making close. Investor 2 outsources to a manager promising alpha and reduces personal oversight. A couple of irrational market moves later, Investor 2 wakes up to losses he didn't anticipate and has limited recourse. The human tendency to delegate away the pain of decision often removes not only responsibility, but the wisdom that accumulates from direct engagement. We will unpack specific preservation tactics, position sizing, leverage limits, and oversight rituals in the next section. For now, hold on to one arithmetic anchor. Small percentage differences compound into large outcomes, and losses are asymmetric. Those facts alone should make you suspicious of any strategy that glosses over downside scenarios. There's one more theme threaded through all of this that cannot be overstated: patience as an active strategy. To most people, patience sounds passive, sit and wait. But patience in the Munger sense is a decision architecture. It's choosing deliberate inaction over emotionally satisfying activity. It is the discipline to keep capital allocated where it can compound quietly rather than constantly rotating in search of excitement. The farmer who prunes in winter is patient in action. The investor who watches account balances obsessively is often impatient in disguise. We will illustrate patience with a classic compounding comparison. Two hypothetical investors of different starting ages. Assumptions: monthly contributions are $400. Annual return 7% compounded monthly. All values hypothetical. Investor early starts at age 30 and contributes $400 per month until age 65. Investor late starts at 35 and contributes $400 per month until 65. By our assumptions, the early investor ends up with approximately $1,000, while the late investor ends with roughly $680,000. 5 years of delay costs the late investor more than $300,000. The lesson is not that starting at 30 is magical. It's that time amplifies discipline. Every year matters. We have now built the psychological and mathematical scaffolding, the reasons to define a circle, to insist on a margin, to invert threats, to guard capital, and to act with patient discipline. The forgotten factory sits at the center of this scaffolding, quiet at first glance, resilient when stewarded properly. Still, the story is unfinished. There are snags that appear only after early success: arrogance, herd chasing, delegation without oversight, lifestyle inflation, and practical countermeasures for each. We've started mapping the terrain, but the next stage is operational. How to set explicit rules, how to quantify margin thresholds, how to structure annual reviews, and how to convert patience into an organizational habit. As we move into that operational territory, ask yourself a sharp question. When you consider the ordinary businesses around you, the local supplier, the steady manufacturer, the quiet utility, how many of them fit the forgotten factory description? And of those, which could you understand well enough to own, and which would you only be tempted to trade on a headline? The answer will tell you where to build your first real positions. Rule 4. Protect capital before seeking growth. Protecting capital is not prudishness. It is a design choice. It recognizes that compounding only works when the engine, the capital, remains intact. The behavioral error this rule fights is the seductive promise of outsized returns that require tolerating catastrophic losses. The math we already touched on, losses are asymmetric, should guide decisions before the seduction of upside takes hold. Imagine the forgotten factory after a series of good years. The owners are proud, the workforce is steady, and the books look healthy. One investor sees the success and thinks, if I just leverage a little, I can double my return. Another investor thinks, if I preserve most of my capital, then when opportunities come, I can deploy without stress. The first path can work in the short run until the market or a technician failure or an unanticipated customer loss exposes the leverage and creates a forced sale. The second path stays in the driver's seat of time, able to compound, reinvest, and wait for favorable prices. Behavioral contrast. Most people confuse confidence with competence. Early wins create a psychological inflation, confidence that encourages larger bets, looser limits, and a tolerance for complexity they haven't earned. That combination is the exact setup for a deep, recovery costly drawdown. Protecting capital is deliberately conservative. Set tight position sizing rules, limit leverage, and insist on liquidity where needed. Narrative vignette. Two partners inherit a small factory. Partner A wants to expand rapidly and funds growth with a loan leveraging the business and their personal assets. Partner B argues to grow slowly, reinvesting profits, and keeping a cash cushion for 3 lean quarters. The first expansion hits a sudden raw material price shock and the loan covenants trigger, forcing the business to sell a division at a poor price. The second path endures, maybe its growth is slower, but it keeps ownership and long-term claims on future earnings. The painful lesson, forced sales at the wrong time destroy compound returns. Numeric illustration, explicit assumptions. This is a hypothetical illustration, not a prediction. Assume an investor has $100,000 and contemplates 2 paths. Assumptions. All figures in USD. Annual nominal returns before leverage. Compounding annually. No tax consideration. Purely illustrative. Path A. Leveraged. Investor uses 2.1 leverage to double exposure, aiming at 10% gross return for the leverage portfolio, but with a potential severe shock reducing portfolio value by 30% in a bear period. If the shock happens, portfolio must recover not from $100,000, but from the reduced equity after losses and any margin impact. Recovery math is harsher and may require outside capital or forced liquidation. Path B. Preserve. Investor keeps 1.1 exposure, targets a more modest return, say 6%, but avoids leverage and maintains a 10% cash reserve for opportunistic buys. If both portfolios experience the same 30% market shock on gross exposure, the leveraged account suffers more severe equity erosion and requires outsized gains to recover, as discussed earlier. The simple arithmetic shows why avoiding large drawdowns is central. A 30% drop leads to about a 43% gain needed to break even. That is the reality of asymmetry. Practical habits to protect capital. Position size limits. Cap any single position to a small fraction of total capital. The exact number should reflect your tolerance and understanding. Maximum leverage policy. Set an explicit ceiling on borrowed exposure, preferably 0, for most long-term compounding strategies. Liquidity cushions. Hold cash or cash equivalents sufficient to weather short-term obligations without forced sales. Annual stress tests. Model adverse scenarios that would cause a 20-40% drop and decide in advance what you would do. Don't invent rules under panic. Transitional note. Protective discipline paves the way for patient capital deployment. When you have preserved the engine, you can use patience as an active tool rather than a defensive posture. Rule 5. Patience as an active strategy. Patience is frequently miscast as passivity, doing nothing while markets do their thing. In the Munger sense, patience is an active framework of decision rules and resistances to noise. Its power lies in thinking in decades, not quarters, and structuring life and choices to benefit from that horizon. Behavioral contrast. The typical modern impulse is to monetize every signal. Buy, sell, react, switch. That energy looks productive, but often replaces compounding with turnover. Active patience, by contrast, is a choice architecture. Rules about when to act, why to act, and how to avoid action triggered by emotion. Narrative vignette. 2 investors inherit identical allocations. One treats their holdings like a garden. Seasonal checks, pruning as needed, occasional reinvestment of yields. The other treats the portfolio like a racetrack, frequent bets on the next sprint. 10 years later, the gardener has a coherent compounding income that funds further growth. The racer has a trail of fees, missed compound windows, and tax friction. Numeric illustration. The classic compounding comparison we used before is worth elaborating with explicit assumptions. Assumptions. All figures in USD, monthly compounding, hypothetical constant returns for simplicity. Investor early, starts at age 30, contributes $400 monthly, annual return 7%, compounds monthly until age 65. Investor late, starts at age 35, contributes $400 monthly, same annual return and period to age 65. Under these assumptions, early reaches approximately $1,000 by 65. Late ends around $680,000. The 5-year delay costs more than $300,000 with the same monthly contribution. The key message: time magnifies disciplined contribution and patient holding. Small delays or impulsive selling introduce gaps that compounding magnifies into materially different outcomes. Active patience practices. Inaction rules explicitly define circumstances that will trigger action, e.g., material change in fundamentals, margin call risks, or rebalancing windows, and commit to otherwise doing nothing. Reinvestment discipline. Set automatic rules to reinvest dividends cash flows rather than spending them unless they serve a pre-specified goal. Calendar reviews, not emotional ones. Replace screen-driven reactions with scheduled quarterly or annual performance and thesis reviews. Mental bookkeeping, separate working capital. Funds you may need within 3 to 5 years from compounding capital. Funds meant to be invested for 10+ years. And treat them differently. Link back to the forgotten factory. Owning these dull, steady businesses requires more than capital. It requires the temperament to hold when headlines shout and the humility to accept slow, sometimes boring progress. Mid and late career traps, pride, trend chasing, and lifestyle drain. Once compounding starts to make a visible dent in your life, new threats appear. They often look less like market volatility and more like human tendencies. Pride, itchy fingers, delegation without accountability, and lifestyle inflation. Each trap is a test of character as much as strategy. Arrogance after early success. Early wins can be misinterpreted as proof of superior skill. Pride narrows learning and widens exposure to unexamined risk. The antidote is deliberate humility. Keep a public or private scorecard of your mistakes. Cultivate a peer or mentor who will challenge decisions, and institutionalize a rule that requires documented rationale for bets above a set size. Trend chasing and the narrative addiction. The media landscape loves momentum, and human brains love stories. Narrative buying, investing because a story fits an emotional arc, replaces analysis with comfort. The forgotten factory is the opposite of a sexy story. It's resilient because it resists fashion. Countermeasure. Require a basic quantitative anchor for any investment story you buy into, and run an inversion test to identify failure modes. Delegation without oversight. Handing decisions to others is often sensible, but it must come with lines of accountability. The mistake is to outsource the pain of decision without retaining enough of the feedback to learn. If you hire an advisor or manager, make reviews structured, annual written reports, explicit fee transparency, and personal involvement in key decisions. Treat delegation like an experiment, not a surrender. Lifestyle inflation, perhaps the quietest leak. As balances rise, so do spending norms. The hidden cost is reinvestment lost to consumption. The remedy is institutional. Set aside a fixed savings rate before lifestyle increases. set warning levels tied to net worth, and enforce a rolling 12-month review before changing lifestyle. Short, cautionary anecdotes. A manager in the story of a family business once added a new product line because it was in. The product required a steep learning curve and deep pockets. Within 3 years, the company had eaten its cash cushion and had to sell a profitable division. Another investor, after a portfolio doubling, authorized aggressive leverage on a sure thing and lost a decade's worth of gains in a single correction. These are not moral tales. They are arithmetic and psychology, operational practices to mitigate later career traps. Accountability partner, a peer, spouse, or committee that reviews big moves and can veto emotionally driven actions. Written rules for lifestyle increases, a formula that ties a portion of incremental gains to savings rather than consumption. Delegation contract. If you pay someone to manage funds, have explicit KPIs, transparent fee schedules, and the right to replace or review regularly. Rebalancing discipline, periodic mechanical rebalancing that forces selling of winners and buying of laggards, counteracting momentum-driven risk. Concrete outcomes, 2 15-year paths. Now, let's compare 2 plausible 15-year stories to make the abstract concrete. These are hypothetical scenarios to illustrate how Munger's rules applied consistently manifest in different outcomes. Assumptions, explicit, all figures in USD, returns compounded annually, contributions made annually, no tax or transaction cost adjustments. Numbers are illustrative, not predictions. Scenario 1, the steward, starting capital $100,000, annual contribution $6,000, $500 per month, simplified to annual. Effective average gross return, 7% annually, reflecting disciplined selection, margin of safety, low turnover. Preservation practices reduce the chance of deep drawdowns. No leverage, fees and costs modest. Future value after 15 years, lump sum growth, $100,000 on 107.15, $275, $900. Contributions, future value, $6,000, 1.07.15, 107, $150, $800. Total, $426 down to $700. Scenario 2, the chaser, same starting capital and annual contribution, $100,000 and $6,000. Higher turnover, trend chasing, higher fees, and 2 significant drawdowns lead to a lower effective return, say 5% annually. Additional frictions, higher transaction costs, and occasional forced sales. Future value after 15 years at 5%, lump sum growth, $100,000, 1.5, top 15, $270, contributions, future value, $6,000, 105, 15, 1, 0.5, $129,500, total, $337,400. Difference, roughly $89,300 in favor of disciplined stewardship. That gap arises from a relatively small return differential, 2 percentage points, compounded over 15 years, plus the drag of fees and turnover. The lesson is simple. Small, consistent advantages in process and temperament, exactly what Munger's rules recommend, produce materially different outcomes over time. Alternate framing with losses included. If the chaser experiences 2 drawdowns of 30% each at years 5 and 10 due to poor judgment and forced selling, the required recovery is even steeper, and the compounding advantage of the steward widens further. The arithmetic of losses, requiring disproportionately large gains to regain previous peaks, works against the chaser. A starter checklist, practical first steps. If you followed this story, how Charlie Munger's 5 rules integrate with the forgotten factory image, you're ready for actionable beginnings. Below is a starter checklist you can implement in weeks and months, not years. Treat these as habits, not rules to be gamed. assumptions. These are process items, not investment picks. 1. Define your circle of competence. Write down 5 industries or business models you genuinely understand and why. For each, note 3 concrete questions you would ask before allocating capital: customers, margins, supply risks. 2. Set a margin of safety policy. Create 2 valuations for any prospective investment: conservative and optimistic. Set a minimum discount threshold to the conservative valuation, e.g. 20-30%, before considering a purchase. 3. Inversion checklist. For every new investment idea, answer, what could cause a 30 or 50% permanent impairment? List at least 3 independent failure modes. If you cannot name plausible mitigations, reduce position size or pass. 4. Capital protection rules. Define maximum position sizes relative to total capital. Decide on a maximum allowable leverage. 0% is acceptable for many. Hold a liquidity buffer, enough to cover 6 out of 12 months of living expenses and/or business contingencies. 5. Active patience routines. Automate contributions and reinvestments. Replace screen-driven reactions with scheduled reviews. Quarterly for portfolio drift, annual for thesis updates. Use decision deadlines to prevent impulsive activity. Major changes must be documented and approved after 48 hours. 6. Governance for later stages. Appoint an accountability partner or committee for moves above a threshold. Set rules for delegation, contractual KPIs, transparent fees, and required performance reporting. Create a lifestyle inflation rule. A percentage of any net wealth increase goes into long-term capital before any discretionary spending. 7. Measurement and learning. Maintain a simple log of all major investment decisions with reasons and expected outcomes. Conduct an annual mistake review where you analyze what went wrong and what you learned. Closing contrast: 2 lives, 15 years apart. Return to the initial image. 2 nearby factories, one forgotten and patiently stewarded, the other a flashier recent favorite. Imagine 2 lives over 15 years. The first person applied the 5 rules, owned modest, understandable businesses, reinvested cash flows, preserved capital, and practiced active patience. The second person chased narratives, paid higher fees, leveraged in good times, and let lifestyle expand as their headline balances grew. At the end of the 15-year period, the first person is less flamboyant but financially independent in a practical sense. Steady cash flows, low stress about margin calls, and the optionality to do things that matter. Work by choice, support a cause, or hand a well-understood business to the next generation. The second person may have enjoyed episodes of exhilaration and status, but their long-term capital base is smaller, more volatile, and more dependent on beating headlines than on owning productive claims. A sober challenge. The path does not require perfect foresight. It requires the modest courage to say no to hype, to hold when others panic, and to protect capital when success tempts recklessness. Final practical steps to begin today. 1. Pick one forgotten factory idea within your circle of competence. This could be a local business model you understand or a stable asset class. Don't buy yet. Write the conservative valuation and the 3 ways it can break. 2. Implement 1 leak plugging habit this week. Reduce trading frequency by half, cancel a noise-driven subscription, or automate monthly contributions. 3. Schedule a simple inversion exercise for each major position. Answer: how do I lose 50%, and document mitigations. 4. Set a one-page rule sheet. Circle definition, margin requirements, position size cap, and review cadence. Tape it where you can see it when tempted by a hot story. If you want a compact tool to guide these actions, download the one-page Munger checklist linked below. It synthesizes the 5 rules into a practical, printable form you can use in meetings, with advisors, or at your kitchen table. The checklist is a starting ritual. It focuses attention, reduces the tyranny of options, and anchors emotion to process. Final image and closing note. Picture once more the forgotten factory at the town's edge. It has a short smokestack, pragmatic signs, and a workforce that knows the rhythm of its machines. Year after year, it makes the same product, pays the bills, and quietly increases the equity claim of its owners. To someone trained in Munger-style thinking, that ordinariness is the central beauty. Invisibility plus durability equals optionality. When you buy such things with a margin, protect the capital that buys them, invert the failure modes, and exercise active patience, you convert modest beginnings into lasting economic power. This is not glamour. It's a slow-working alchemy made of discipline, arithmetic, and temperament. The 5 rules: know your circle, demand a margin, invert the problem, protect capital, and be patient with purpose, are tools you can apply tomorrow. They don't require perfect insight. They require consistent practice. If this message landed for you, download the one-page checklist linked below and keep it beside your notes as you evaluate ideas. If you want more examples and a downloadable template to run the inversion and margin calculations we discussed, the link is below as well. Subscribe for more long-form breakdowns like this, and consider sharing this with someone who assumes that wealth must look like headlines to be real. Start with what you have, protect it, and let time do the heavy lifting. That is how Charlie Munger's 5 rules transform capital, not through magic, but through steady, disciplined habit.